Okay, thanks for joining me for our Q4 2025 model portfolio commentary. 2025 is in the books, so let's take a look at how we ended the year. We'll recap the key market drivers from the fourth quarter, review model portfolio performance, highlight major contributors and detractors, and wrap up with positioning considerations and planning opportunities heading into the new year. Let's dive in. We have a few important catalysts in the fourth quarter. First, the government shutdown. The prolonged shutdown delayed several key economic releases, creating a temporary data blackout for investors and policymakers. That lack of timely data added uncertainty around market expectations and made it more difficult for the Fed to clearly signal its policy path. Second, the labor market. As delayed data was eventually released, it became clear that job growth slowed meaningfully late in the year. The unemployment rate rose to roughly 4.4%, the highest level we've seen in several years. And third, geopolitical tensions. Risk remained elevated, particularly around US-China relations and sanctions affecting Venezuelan oil production, which influenced global energy supply and pricing. Now let's turn to performance. For the fourth quarter, markets continued to move higher, ending the year on a strong note. Looking at what drove performance beneath the surface, gold earned a gold star, up 63.7% for the year. International equities outperformed US markets in 2025, with both developed and emerging markets posting strong double-digit gains. Large-cap US stocks continued to deliver, with growth outpacing value. Fixed income also contributed meaningfully, particularly emerging markets and mortgage-backed securities. In the dividend growth model, we saw strong gains across several sectors, including Raytheon, Eli Lilly, and JP Morgan. On the detractor side, small-cap stocks were positive but still lagged broader markets. Certain fixed income segments, such as developed international and preferreds, trailed. And in the dividend growth model, we saw underperformance in Aon, ONEOK, and Brown & Brown. As we look ahead to 2025, there are a few themes worth keeping in mind. First, the midterm elections. Historically, markets sometimes underperform heading into midterms, but frequently rally as uncertainty clears. Second, consumer sentiment. Confidence remains muted, with the Michigan Consumer Sentiment Index ending the year at 53, roughly 28% below last year's levels. That could weigh on consumer spending and growth expectations. And third, global economic shifts. China's move towards consumption-driven growth and structural reforms in the Eurozone are helping support global demand and long-term growth prospects heading into 2026. From a planning and positioning standpoint, we're getting ready to do our January rebalance, aligning allocations with target exposures and updated market expectations. This is a natural opportunity to discuss strategy, risk management, and portfolio adjustment with clients. High earners must make 401k catch-up contributions on a Roth basis, creating an opportunity to revisit savings and future distribution strategies. And the Enhanced Affordable Care Act premium tax credit expires at the end of 2025, potentially increasing premiums in 2026, making this a good time to review coverage, budgeting, and plan selection. As always, thank you for your continued trust and partnership. Thanks again for watching, and Happy New Year.